This conference will
It
now be
is
recorded.
good afternoon, everybody. It is 12 o'clock on Wednesday, April 1st, which I guess makes this April Fool's Day, but unfortunately, I don't think we're living in a joke right now, and there's certainly no April Fools going on here. We are continuing with our lunchtime WebEx series. And today we are featuring a WebEx titled Placing Business Now in this low interest rate environment. And our featured speaker is Joe Sienna, who is the Director of Advanced Markets with John Hancock. And Joe is really going to talk about leverage and leveraging opportunity. We are living right now in an environment where there is opportunity for all of your clients. And what I'm hoping that everybody is going to do while they're listening to Joe's presentation is thinking about the clients that they have that this opportunity is going to apply to, and writing down a list of 1, 2, or 3 names that you're going to be able to really discuss these concepts with once this presentation is over. We are going to take questions and answers, but I would request that you hold your questions until the end. If you've got a specific slide that you'd like us to discuss, just write down the slide number and Joe will go back to that slide and we will answer all of your questions at the end. So with that, I'm going to turn this over to Joe Sienna. Good afternoon, Joe, and thank you for joining us.
Well, thanks, Kathy, and I hope you all can see the screen, and I hope I'm coming through okay. First, I just want to thank Agency One, Gonzalo, Kathy. Thank you for inviting John Hancock in participating in these webinars. I know I've always enjoyed working with you all over the past 18 or so years, and I look forward to expanding our relationships as we pass through these difficult times. While today it may seem a little difficult to get in front of clients to discuss their insurance needs, I know as we exit this period, I suspect many of your clients are going to be open to reviewing their estate and wealth transfer plans. Given where we are with today's low rates, the ideas we discussed today hopefully are going to help you engage with your high net worth clients and show them how they can take advantage of this opportunity to further their estate and wealth transfer plans. So, okay, where are we? This past April, Treasury announced the April AFR rates, and they are the lowest we have seen in some time. As a matter of fact, the long-term AFR has reached its lowest point ever at 1.44%. One might expect these rates to remain low, at least in the short term, but the opportunity we have now to use planning techniques that utilize these rates just might be at their best. Let's look at where the rates are now. Since January, the rates have remained fairly steady, but as you can see, they pretty much crashed in April. When you compare today's rates to the 20-year averages, you can see we're at pretty unique times. Virtually all these rates sank by more than 50 basis points in the month of April. As you can see, the short-term and mid-term rates are below 1%. Long-term, as I mentioned, hit its historic low at 1.4. 60, 75, 20 rates, that we use for GRATs and CLATs also dropped significantly down to 1.2. So let's take a look at these planning techniques that utilize some of these rates. Why do we use these loan techniques? Well, generally, these techniques are used as alternatives for making outright gifts, or for those clients who've exhausted their gift tax exemption, or people just want to use use it for estate freeze purposes. Private finance, or really what we call now wait and see loans, we use that a lot, and also for intergenerational loans. Term loans between a donor and their trust, asset sales. We see that mainly for family businesses, FLPs, LLCs, things like that. GRATs, as you know, a very popular wealth transfer technique, especially at today's 75/20. We also use GRATs or illustrate GRATs and CLATs as exit strategies for commercial finance, private finance, and also private split dollar. We're actually seeing an uptick in activity in the corporate space. Executive comp plans using 7872 loans. So as you can see, the reach is rather broad as it relates to the use of loan techniques, not only in the wealth transfer, but also in the business planning space. So is now the right time to make gifts? Well, besides the emotional aspect of making large gifts today, when you look at where we're at with current tax law or the current economic or political landscape, are we certain that present tax laws are going to remain in effect through 2026 when they're set to sunset? Will the estate tax laws change between now and then? Well, no one really knows. So there's some hesitancy on whether or not, when's the right time to pull the trigger on making that gift. Today, the basic exemption in the GST limit is at 11.6, and it's going to fall back to 5 million plus inflation. So really, who knows what the exemption may be under present law. There's a lot of clients that may feel they're either not ready, willing, or able to make outright gifts today. Loss of control, loss of income may be two reasons. And of course, now lower asset value might be another reason. So when you're talking to clients about wealth transfer plans or estate planning, if gifting is not an option or if there's hesitation by the client, remember that decision to make that gift does not have to be made today. Clients can use these loan techniques to basically reserve their decision until there is more clarity in the tax law, and or they just want to take advantage of the estate freeze opportunity that we have with these low rates. They could still retain control of the asset because they're actually holding the note. So let's talk a little bit about asset value. Another reason why these techniques may be really useful today is that recent stock market performance has devalued many people's assets. Now, this could present a perfect opportunity to transfer quote unquote discounted assets out of their taxable estate. The estate freeze at the low AFR, as well as the lower asset value, could enhance the total value of their wealth transfer plans to the heirs once recovery occurs. So consider that $1.5 million asset you may have had in January. It may be worth only $1 million today. That's a 33% discount in value, which you can apply against your basic gift tax exemption via a gift, or they can loan that asset, freeze the value in the estate at the low AFR, and decide on making that $1 million gift somewhere down the line. Remember, by making that loan today, you freeze the value of the asset in the taxable estate at today's depressed value. In this case, you're freezing it at $1 million. Let's talk a little bit about recovery. What does history tell us? Well, it tells us that periods of high return usually follow sharp decreases in market value. If you look back at the last two market corrections in 2002 and 2008, they were followed by very strong recoveries. The most recent in 2008 was followed by average returns in the Dow of over 11% through 2019. If you go back to 2002, which would include the 2008 correction, which was over 30%, the average return through 2019 was over 8%. Therefore, by moving that asset out of the taxable estate now at the depressed value, or freezing the value in the estate using loans, your clients have the opportunity to transfer all that potential growth out of their taxable estate and into their non-taxable estate or trust. Let's apply some of these points in a case study that I recently put together for a producer. Now, we're going to be talking about wait and see loans or private finance. And the flexibility of private finance is best described in that context of wait and see. Make the loan now and decide later on the gift. So in this particular case, we had a very affluent client, both 860, and they both were willing to use their devalued asset, but they didn't want to make the gift now. So what I did was I illustrated a long-term loan, a 15-year loan at the long-term rate of 1.44%. Now, in doing some of these designs, some may argue that the terms of the loans or these sales should be even longer, given where we are at today's rates. But for the sake of this discussion, we're looking at a 15-year loan. And we're going to assume an average return of 8% based upon past experience. So when you put these assumptions together, what it generates is basically a premium of $303,000, which is enough to buy a $27 million policy. Of course, we add vitality. We're using an index UL with the cap at 5.9. It has a 29-year guarantee and a target of $344,000. So it's a nice little case. Show you how this works. Once the $5 million loan is made between the donor and their trust, the trustee invests those loaned assets, and if we assume an 8% return or $375,000 on those loan monies, the trustee will have enough to make annual tax-free interest payments back to the donor of $72,000, plus make the annual premium of $303,000. Therefore, we're only using the asset's annual growth of $375,000, and we're preserving the principal. Now, the beauty of private finance is you can lock in these loan rates for the term of the loan. So the long-term AFR of 1.4 is fixed. So there's no interest rate risk. Hence, the donor still retains control of the asset and its income by receiving that interest payment and has not used any gifts. The donor and the trustee now have until 2025 under present law to decide whether or not to keep this loan in place. If they decide, in this example, in 2025, to forgive that loan, they could basically rip up the note and it becomes a gift. Now, the trustee retains the loaned assets, and of course, he'll use those assets to make any remaining premium payments, but they'll be able to retain the balance in the trust for the benefit of the beneficiaries. So as we're illustrating here, at life expectancy, the original loaned assets would grow to over $23 million. If you include the value of the life insurance death benefit at life expectancy, the total trust value exceeds $50 million for basically a one-time $5 million loan or a $5 million gift. If the clients decide to keep the loan in place in year 15, the trustee would just take the original loaned assets, hand them back to the donor, repay the loan, the transaction is completed, and the policy is paid up. So just to show you the impact of these low rates, what would this transaction have looked like last year when, even last year, we thought rates were still relatively low? So if you look back at April 2019's long-term AFR, it was about 2.9%. To duplicate this loan arrangement in April of 2019, the amount of the loan required would have been about $6.4 million. Compare that to today's $5 million loan, that's a 22% reduction in the amount of the required assets needed to accomplish the same result. And you'll see the same reduction in assets as it relates to the use of GRATs or CLATs, as those rates last year were 3%. Therefore, to get to that same remainder interest for a GRAT, you would contribute a lot less today than you otherwise would have last year. So, as you can see, these current events can have a tremendous impact on how you design these types of cases.
Hey, Joe, excuse me one second. I could ask everybody to 100% mute their lines. That would be great. We're hearing a lot of background noise from offices. We're hearing noise in the background. So please, everybody, mute your lines. Thank you.
Okay, so now that you have an idea of how these techniques works, and asset sales basically are not any different than private finance. It's basically form over substance, talking about a hard asset versus a liquid asset. But who can you talk to? Well, these types of designs resonate with clients I've seen as anywhere from 5 to 10 million, obviously, and up. In the intergenerational space, I've seen $5–7 million clients using these techniques for generational loans between themselves for the benefit of their grandchildren. You're going to look for clients maybe you've talked to about or have not exhausted their exemption, have gifting capability. There's going to be some hesitancy on whether or not they want to make gifts. And of course, those clients who've exhausted or have little remaining of their exemption, these financing techniques basically become their only option to do some creative insurance financing on a gift tax favorable basis. The types of assets, well, outright gifts, you can gift any kind of asset, liquid asset, hard asset. Private financing, the type of assets you're going to use, generally you're going to be liquid assets, cash, securities. Asset sales, mainly income producing assets. You want the type of assets that's going to generate some amount of cash flow to make that interest and or premium payment. So, business interest, commercial real estates, things like that. GRATs or CLATs, that's pretty much a catch-all. Securities, business interest, real estate, highly appreciating assets, excellent GRAT assets. And depending on the client's age, especially for survivorship type cases, private split dollar, still, even at these low rates, from a from a gift perspective may be just as or even more effective than a private loan arrangement. I kind of talk to private split dollar as a pay-as-you-go type arrangement. Instead of making a lump sum $5 million loan as we saw here, the donor can just make a series of, quote, loans equal to the payment, equal to the premium payment. Designing the exit strategy, that's where the GRAT or CLAT or gift can come in. Again, I could forgive the collateral assignment on a split dollar arrangement and it becomes a gift. Or from doing CLATs and the insurance trust is the remainder person, well, as those assets fall into the trust, again, those could be used as the exit strategy. But I think most important, as you go through, look back at some of the cases you've designed in the past and review them. I went back to November and reran all the cases that I created since then and updated them with the AFRs and sent them back out. And so far, it's generated some conversation with the producers. If these cases were gifting cases, well, maybe you can go back to your clients and talk to them about the financing rates, especially if there's any hesitancy on whether or not they want to go forward in making the gift. If you were talking to them about private finance or asset sales, well, of course, go back and update the rates and show the lower asset commitment. Maybe by adding SLAT features to the discussion of the trust, that might help.
Hey,
It even
Joe.
adds more flexibility. Yeah.
Joe, I'm sorry,
Yes.
this is Lisa. I have to interrupt. Somebody inadvertently took the screen away from you, so you have to go back to
Sharing my screen.
yeah, sharing your screen the way we did in the beginning.
Okay,
There
we're
you
there.
go. I think we're all set. Yeah.
Okay. All righty. So yeah, reviewing cases. Talking about SLATs, GST planning. The case design we just talked about was pretty much a death benefit design. So we were looking for maximum leverage on the death benefit. But the policy design really is independent of the loan. If you wanted to look at a cash value type contract, where you wanted to create a high cash value contract, you could certainly use a private loan arrangement and overfund a variable or index contract. So the policy design really is separate from the loan, depending on the facts and circumstances and the client's needs. That'll dictate how you design the policy. The loan arrangement or the sale, that's basically the method on how you want to pay for it. So that's basically it. We're in unique times. We have unique opportunities, and hopefully what we just went through is going to give you some ideas that you can go out and reach out to your high net worth clients and revisit some of those cases that may be on hold or uncovering some new opportunities. It's funny. They say those who hesitate, are lost. Well, I think if you hesitated in plans from January and you institute them now, you might come out better than if you had otherwise started these transactions even in January. So with that, we can open up to any questions you may have.
Thank you, Joe. Does anybody have any questions?
Yeah. Hey, Kathy, it's Gonzalo. Can you hear me?
Yeah.
I think just in reflecting on all this, I just want to make one quick comment. I mean, I think to Joe's point is if you look at, everybody last year, or even 2 years ago, was like, how much lower can interest rates go? Well, here we are. I don't know how much lower they can go than almost zero, but the biggest challenge right now, I think, is people just get, they're thinking about other stuff, and they're also thinking about, how am I going to underwrite a $20 million case or a $10 million case? This is a complex sale. That there's a lot going on here. I think there are clients that can really take advantage of, the reduction in the market values and the reduction in asset values to make some very meaningful gifts or loans. I'm sorry, as Joe pointed out, and the leverage that comes from that reduction in asset value relative to the loan and ultimate transfer of those assets as an estate freeze strategy is very powerful. The bigger challenge is, implementing any kind of plans right now with, attorneys off, on Skype or on Zoom or whatever they're doing. And I know that there's a fair amount of attorneys that have been advertising that they're getting documents done and they're meeting with clients virtually and so on and so forth. But then the other big problem is, underwriting a $20 million or $10 million case. And we've had lots of conversations around that over the last couple of weeks. Anything that would involve a strategy like discounting based on the interest rates that we have today are probably things we need to start at least talking about sooner rather than later. But underwriting a case like this is going to take several months anyways. So it's just something to be mindful of as you kind of think through some of the opportunities you may have in this space, because the time is definitely now. There's going to be some challenges, no doubt, but there's no better time to do planning than with the low interest rates we have right now.
Gonzalo, I'm glad that you brought that up, because, these are concepts that, with the help of Joe Sienna and, his really, really bright colleagues at John Hancock, we've been talking about these things year over year. And you and I have been talking about the concept of, timing is everything. And when we were talking about putting these WebExes together and reached out to Joe and our friends at John Hancock in terms of what did they think were some of the best concepts that they could discuss in less than a half hour, just to kind of re-educate and remind, these concepts, jumped out first and foremost because this, if you've been waiting, if you've been having these conversations and they keep getting put on the table, this is the time to kind of dust them off and go back to the clients and say, listen, there is no better time than now for all of these reasons. And if you're going to keep waiting, it's not going to get any better. We never thought that it was going to get as good as it is right now. Rates can't go to a negative. At least no one's ever told me that they could. We're here to help. John Hancock is here to help. Let's get the underwriting started. Let's just start to get all the ducks in a row and go through the checklist. And let us know how we can help. Okay, Gonzalo, anything else?
Sorry, Kathy, I put you on mute. No, I'm good. Joe, if there's no any other questions, I think we're good for today. Joe, I can't thank you enough for sharing your thoughts on this, and Kathy, thank you for hosting.
Kathy,
Terrific.
Kathy,
Yes, sir.
hello. This is Bob Larkins. Will a replay of this webinar be available?
Yeah, that's been recorded and it'll be available on our website.
Okay, great.
As will all of the others. Does anybody else have any questions? Well, thank you everybody for participating and listening, and we thank you for your support. The next WebEx is going to be Friday, again at 12 noon, and it is going to feature none other than our partner Gonzalo Garcia and Ed Stark. And we're going to be talking about carrier premium deposit accounts, but it's going to be much more than that. It's really how you can take advantage of these really attractive rates and using carrier products with these rates to you again take advantage of an opportunity in the marketplace to design opportunities for your clients. So this is something that we've been working on for quite some time with a variety of support, and we hope that you will dial in. There will be a reminder that's going out this afternoon, and again another one on Friday morning. So we hope that you're going to segregate Friday from 12 to 12:30 to once again dial in. Terrific. Okay, and with that, I wish everybody a great Wednesday. Hopefully everybody will be able to get out and take a walk, and stay safe and keep doing what you're doing. Thank you.